Hi, Andrew Nelligan here again. Now you might be wondering what is best, a ISA or a pension, and so the purpose of this video is to explain the two different types of savings and investment wrapper, but also to point out that best really is a subjective term, and it depends what you need one for and what your circumstances are. For example, if I'm going on holiday to Europe and I want to drive around in comfort and luxury, and it's maybe just me and my wife, we might choose to take a sports car like a Ferrari or a Aston Martin. But if I'm going with my family and we're going to have a lot of luggage, well, a sports car is not going to really be much help, so I'd want a bigger car like an estate car or an SUV. And so it is with a ISA and a pension. It really depends on your circumstances, what your objectives and your priorities are. But in comparing them, I'm going to talk about how they're treated when the money goes in, the contributions you make go in, how they're treated while the money's in each of the tax wrappers, what happens when you want to take the money out, and also what happens when you die as well. And for the purpose of this video, when I talk about ISAs, I'm talking about share ISAs or cash ISAs, as opposed to things like Help to Buy and lifetime ISAs. So starting with ISAs, when you make a contribution, you're going to be making it from income and savings after you've paid tax. And you can put up to £20,000 a year into a share ISA or a cash ISA, or a combination of the two, and whatever you put in gets invested. There's no supplementary payment like tax relief. And when the money's saved in the cash ISA or it's invested in a share ISA, it grows free of tax, and you can access it at any time you want. Even if you put the money into the ISA and the next day you decided you made a mistake and want it back, you can do so. And when you get it back, it's free of any income tax and any capital gains tax. But when we're thinking about what happens when you die, an ISA forms part of your estate. So when you die, the value of all your assets will be added up, and it is possible, if you've got a large estate, that there will be inheritance tax to pay. Pensions, on the other hand, when you make a contribution, you benefit from something called tax relief. And what tax relief is a payment from HMRC into your pension pot as an incentive to save for retirement. So everyone, regardless of their income, would receive 20% up front at source, and that, as I say, goes from HMRC directly to the pension. Now, if you're a higher rate or an additional rate taxpayer, you can claim back the additional 20 or 25% tax that you've paid by completing a self-assessment or contacting HMRC directly. In terms of how much you can put into a pension, it is slightly complicated, and I've done another video on this, so look out for that one. But in simple terms, it's the lower of 100% of your earnings, or up to £40,000 a year. As with an ISA, when the pension is invested, it grows free of any tax. But one of the main differences between the two is when you want to access your pension. For a start, you have to wait until at least age 55, or that is increasing to 57 from 2028. So the accessibility isn't as great as an ISA. And also, when you access the pension, once you've reached that minimum pension age, you can receive 25% of the pension fund as a tax-free lump sum. Anything else you take from it would be taxed as income in the year that you receive it. And because a pension is designed to pay out income for the rest of your life, it will be potentially taxable throughout your life, but that really does depend on other income that you receive in that year. Now, one of the advantages of a pension, as well as having a tax relief payment up front, is a pension is outside of your estate from an inheritance tax point of view. So if inheritance tax is likely to be an issue for you, then saving into a pension can be very appropriate. The actual tax treatment on death is a bit more complicated, and I will do another video on that. But for the purpose of this video, it all hinges around the age of 75. So if you die prior to age 75, then it's free of tax on the beneficiaries. If you die after 75 and the beneficiaries of the pension receive it all as a lump sum, then it forms part of their income for income tax purposes, so they might have income tax to pay on it. Another consideration with pensions compared to ISAs is with ISAs it doesn't matter how big your pension fund is. There's no limit on the size, whereas with pensions there is something called the lifetime allowance, and with the current lifetime allowance, if your pension fund is over £1,037,100, there's an additional lifetime allowance charge to be had. So that's the very simple differences between pensions and ISAs. So you can see there's not necessarily a case that one is better than the other. It really does depend on your unique circumstances and what you're trying to achieve. And in an ideal world, you'll be maximising both your ISA and pension allowances each year to get you to that point of financial independence and financial security for the rest of your life. But I hope it helps, and I hope it's answered that question for you.